Hello, everyone. Welcome to today's session. Let's get underway here. Just get my drawing tool out here. Got a few things to talk about here regarding market conditions that I think are going to be timely here today with markets, what they're doing what they're doing, looking for a bottom essentially right here on the markets as a whole. So let's talk about a few different things here. Let's jump into current market conditions. We'll start out with direction alerts. Remember that direction alerts process is looking for a top-down process. We want to see what's the big picture first and foremost, and then from there drill down into where are we at in that big picture. Are we late in a trend? Are we early in the trend? Are we stuck right in the middle? And then trying to determine what is the best way forward based on those current market conditions. So right now, obviously, we know that we're in an uptrend still. It started in about May, I believe May or April of last year. April 28th was that initial uptrend signal, and we've been continuing from there. I guess you could kind of see that right here as well. That's when that signal is generated. So we know that we were deeply oversold and we were working our way back this direction. So that's going to start even back in here. And then we get this momentum shift happening right here on that on S&P 500. Now we've been topping out, we've been retracing. The question now is, are we rolling over into a new downtrend, or are we going to pause and continue with an overall uptrend? And obviously we can't tell the future, but we'll look to see where we're at right now. We are bearish in a bear market, bearish in a bull market. This uptrend here representing a bull market. We've been flattening out here now in this long-term trend and just retracing. It's taken a little bit of time here going down to this shorter term signal. We've got this support area. We've been working on this retracement now for really most of the summer, August, September, October, for 3 months now. And the question is, are we done? Are we getting close to a short-term bottom? Are we going to continue this overall downtrend? And so we'll look at a couple of scenarios. One of the things I mentioned in this morning's update was the divergence that's happening on momentum. The red line right here, this red line is momentum, and it's as price activity is dropping. So one of the things with divergence is when you're dealing with price and then some kind of an indicator as well. And oftentimes what will happen is you'll get divergence where you'll get a low, and then in this case you get a new low on the price. And here on the momentum you get a low, but then you get a higher low on the indicator. So price is doing one thing, the indicator is doing another thing. That's called divergence. We're getting that on price right here with the new low. And we want to see that on a new low. If you don't see divergence on a new low on any oscillator or indicator that you're using, then it's probably not, the low is probably not in yet. Almost always you're going to see some kind of divergence if you're using some kind of a little bit of a lagging indicator. This momentum indicator is a slight lagging indicator, which all indicators are. Price is the only non-lagging indicator because it is what it is. Other indicators are based on price, and so it smooths the data, or it gives the data just a little bit different perspective, just a little bit different look, and adds to it. Ideally, it should be complementary to what your price pattern is. So we're seeing that in divergence right here in momentum. We're also seeing it a little bit in breadth, and breadth is, remember what breadth is. Breadth is, in this case, breadth is, in essence, it's a little bit different, but in essence, it's the number of stocks that are trading above or below a 50-day moving average. So in this case, the number of stocks in the S&P 500 that are below a 50-day average is 13. Okay, or and that is, that's getting to that low end. So we're seeing more and more stocks that are just bottoming out right here, and that we obviously know that because that's what the trend is doing. Sentiment is now focused on a little bit more on speculation, and that is what is happening in terms of greed and fear. Is the market fearful or is the market complacent? We're still in this upper complacency zone, which is in this upper range. So you can see the range that it can be to. It can drop all the way back down into that lower range. We're in the upper end of that range. That's what we want to see on a uptrending market. Is we want to see a retracement in price activity, oversold with momentum, oversold with breadth, but not oversold with sentiment. And so the table is kind of set there for that. That's on one indicator. That's on this on direction alerts. The buy sell ratio, this is probably my favorite indicator of all indicators, because it is a true representation of the entire market for the most part, about 6,000 stocks, but it's catered towards our signals and our determination of what an uptrend and a downtrend is. So in this case, you've got a wide setting on stocks right here, where you've got this entire move here, and you've got the distance. And notice I've talked about this before. There is an upper range. There's an upper range on the sell. There's a lower range on the buy. And at some point, there's no way it can go down any further. Okay, and the reason why is because right now, if I mouse over that, you can see there's 340 stocks in uptrends. There's 3,500, 3,600 in downtrends, or that have sell signals, and there's probably another 3,000 or 4,000 that are in holds. This is only calculating the buys and the sells. So there's a bunch that are stuck in the middle as well. So this could go a little bit lower or higher. Could go a little bit lower if more of those sell signals, if more of those hold signals jump over into the sell range. Okay. But when we start to get this extreme, we get this ratio down here, the buy sell ratio. And just to kind of reiterate, this middle range right here is 1. So when we have a buy sell ratio that is 1 or higher, we're getting bulls. Okay. If we have a buy sell ratio that is less than 1, we have bears on charge, and this ratio is down here at the bottom. So if I put the mouse over top of this, it's got a 0.09. Whereas when it's green is above red, you can see here, this has a buy sell ratio of a number larger than 1. So it's a ratio of 2. And if I were to go down and down and down, you can see 0.64, 0.7. When they cross over, when this crosses over, when green crosses back above red, this buy sell ratio is going from, let's see if we can find that exact date here, July 10th. So here's the 7th at point, the 6th is 0.64, 7th point is 1.07. So right here's where you get this crossover. Just like on the downside, right here, you have 2.0, and then it jumped pretty aggressively down that next day, 0.92. The theory behind this is that we should be able to stay out of the market or trade bearishly if we have a buy sell ratio that is less than 1. Okay, if the buy sell ratio is less than 1, then we want to not be either not be aggressively adding into stocks, or not be in stocks at all, or trading or something bearish. We can use that as a hedge if you've got long positions and you're already in long positions, and it looks like we're moving a buy sell ratio in the down range. Then you can use something like an inverse ETF or put options to be able to hedge against downside. If you've got positions that you're like, I just don't want to sell them, then that's one of the ways to do that. Again, one of the ways to trade bearishly, if you don't want to short stocks or buy put options, is to use inverse ETFs. And an inverse ETF is basically an ETF or something that goes up when the other thing goes down. So in this case, you'll usually see something like this, like a direction. This direction is the name of the brand. It's the company that provides this and puts out these ETFs. ETF is just an exchange traded fund, which is just a basket of stocks, but they trade like a stock. And so you're getting diversification. But in this case, you have inverse and leveraged. Leveraged because it's a negative 3x. What that means is, in this case, the biotech sector, if the biotech sector goes down by 1%, this is going to go up by 3%. it's leveraged to the downside by 3%. That's why it's a negative 3x, because if the index that it's following or the sector that it's following drops by 1%, then this is going to go up by 3%. So not only are you leveraged, meaning you're getting a compounded or a multiple effect on the return, it's also inverse. You're getting that in an opposite move. So today it's down by 7% because the biotech sector is now rallying. It's now, it's got a nasty looking bearish chart and it's now bouncing. Whereas this has been dropping and now it's moving the other direction. So even back here, and we can say, well, let's start to watch for buy-sell ratio of less than 1 right here. Let's jump out and let's look at ETFs that are starting to move. Let's see when that buy signal was. There were a couple of them here. I think this might have been the big one here. What's the date on that? That's this green bar here is July 27th. If I go back to the buy-sell ratio here, it was July 27th was right about here. So they were starting to work their way back together, and then you get a crossover, and then you get multiple signals here, and it retraced, and then you got another one right here. So this is a way to say, oh, okay, we're switching gears. We're switching from a bullish trend to a bearish trend. What do I do? How do I trade that? Is there a way for me to, do I have to just sell everything and be out of the market, or is there a way that I can profit from the downturn? This is one of the ways. It's a very easy way to be able to do that, because number one, you don't need a margin account. You don't have to short anything. In order to short a stock, you have to have a margin account, and you may not want to do that. It also shorting ties up capital. This also ties up capital, but it's just an easy way to be able to do that. Shorting is also easy, but this is just one additional way to do that. And I just happened to pull this biotech one up. Obviously, it could have been anything that may have had new buys during that. So ultra short utilities right here. Yesterday, it was moving higher. And obviously today utilities are rallying. So now we're seeing on all these inverse ETFs that have had this big run up during the market collapse here. And I wouldn't say collapse, I should say just a counter trend. And now it could be and should be starting to switch back the other direction. Okay, so let's talk about that now. When we get to this level, 0.09, anything less than 1, historically is a sustainable market bottom. Okay, some of these real big ones, like this one right here, you can see how much wider. We're right about here. Some of these are really wide. Those are obviously going to be a little bit lower, but let's look and see right here. So here's 0.08, 0.09, 0.08, 0.12, 0.10. Okay, that was it. 2 or 3 days of 0.08 or lower. Right through here, let's look. 0.12, here's a 0.06, 0.20, 0.09, 0.06, 0.11, and away it goes. And that's it. Okay, we had one right here too, 0.13, 0.09, 0.11, and that was it. So now we've gone from 0.14 to 0.09. We could continue to slide and go down to that 0.06 range. But that if it doesn't happen in today, it's going to happen within the next 3 or 4 days. Probably a significant market low, at least based on the history of this indicator. That's been, if I go back 3 years, let's even go back to 4 years, because I think it was that COVID low. This was the COVID low that it just went haywire. Okay, look at that. There was 44. I think I got 44 buys and 5,000 sells. That was that was March 16th of 2020. We'll remember that date, March 16th of 2020. And let's come down here. March 16th was, you can see 0.01, 0.02, 0.03, 0.01, 0.02. So that was the absolute lowest that this has been in the last, at least in the last 5 years, and I think probably in a long time. So that 0.01, 0.02 with 46, 48 stocks that are in a buy zone, that's probably as bad as it'll ever get, because that was nasty. We had just really bad capitulation right there. But this March 16th, if we go out to, let's go out to SPY, and let's go back a couple years and see if we can pick that up. Let's go July. Let's go March. There's March. We'll go here and pull in this price data and look to see what was happening on March 16th, and see right here. If I mouse over this, so here is March. It's gonna be a little bit hard to see, but here's March 16th right here. So the 16th, 17th, 18th, 19th, those 4 days right here when it was at 0.02, 0.01, that was the market bottom. Okay, that was a major market bottom. And every single one of these bottoms, even if it's in a bear trend, bottoms out around that level. So now we're getting close to that level. We also have some other things to be watching. Remember that on this time frame, from the COVID low to the I don't know what you want to call it, COVID high, this most recent high that we had a year and a half ago, that swing high and that swing low, that still is a trend that is intact. And if you notice this line, if I were to extend that over, it bounced right at the 50%. Now it's rallying higher. Now it's retracing. Now look where it's at. It's right at that 418, which is that 236. That's our momentum zone. So on this time frame, it's a pretty long time frame. We're still inside of momentum zone, and we could bounce right here. So we've got several indicators that are saying we've got major support, which is probably the most important indicator, is price at a location that it has been at before. And we've got an extreme level of sells. Okay, that we could, you saw how low it could go, 45 stocks in uptrends, and we're at about 300 in uptrends. So this perspective is significant for what we're talking about, and that is, could we continue this overall uptrend? Could we bounce right here and continue this overall uptrend, or are we in a new downtrend? Are we or is something like this happening now? And yes, we may bounce and rally and head back up, but are we ultimately headed for more downside? We won't know that yet. We won't know that probably for the next 3 or 4 months. But the conditions are actually still quite bullish, although it feels like they shouldn't be. I also mentioned the other day about the buy-sell ratio. I'm going to touch on a couple of these things just because I feel like they're kind of important for current market conditions, and that is so let me actually go into this one, and we'll just highlight this time frame here, which, by the way, if you want this selection tool, if you want to just capture and grab a smaller piece, you can just highlight it like I just did. So now we've got this swing low from October, we've got the swing high, and now we're right at this 382 level as well. Did I get the low? Yeah, I think I got the low. What was the low? And so we can see right where we're at. Oops, I actually cut off the current market information. Let me slide that over. There it goes. So we've got a support level that is approaching, major support level that's approaching. We also have, then we've got our buy-sell ratio. Think of the buy-sell ratio as the market. It is just it's a little bit different representation of the market. And because all a market is, when we're saying the stock market, we're just talking about this. We're talking about all the stocks out in the world, out in the tradable world. That is a marketplace of stocks, and we happen to lump them into different indices like S&P 500. Okay, so that's a group of 500 stocks, and we call that one index, or we call that a market. The Dow 30, that's another group of stocks that we tie value to the activity of those 30 stocks. We tie value to, or link value to, the NASDAQ 100. It's the 100 largest tech stocks. This is all of them. It's all of them together. So in this case, we're saying the entire market right here has a ratio of 0.09. Historically, that's low. It could go lower if things were really bad, but we're not in a pandemic. We're not, we're not in a recession. We have an interest rate issue and an inflation issue, but that's kind of always happened. We've had lots of those over the years, and so it's not a huge deal. Obviously, it's the Fed wants to be able to manage that and get it lower. But one of the things I mentioned in one of the last updates is if you look back to the 1990s and you go starting right here, we even back to 95. You had a flat yield curve that was relatively high. It was above 5%. So both short-term interest rates and long-term interest rates were about the same. It wasn't inverted, but it was pretty close to it. A typical yield curve uses the 2-year and the 10-year. You can see it's slightly higher. Inverted means it's down just a little bit, and we'll look at that. But as I scroll through the 90s, watch what happens here. So I'm going to go 1995, 1996. There's almost inverted, but it's flat. 1997, 1998, 1999, 2000, 2001. So now we really start to invert. But we went 5 years, almost 6 years of short-term rates about 5.5% and long-term rates about 5.5%. So the market conditions that we're in right now obviously can be sustainable at those interest rates for a long time, and we can have a massive bull market during that time as well based on those interest rates. The market just has to digest it, and the market has to figure out, is this the new world we're going to live in? If so, it's going to adjust. Companies are going to adjust. They're going to manage their debt load differently. They're going to borrow differently. They're going to do a lot of things differently. And that's what companies do. That's what good companies do, is they just have to pivot into what the current environment is doing. So that is a bullish stance for me in this situation. There are a few similarities. We have a new technology, AI, similar to the internet. This was the internet boom in 1998, 99, 2000, and then the bust. Okay, we'll probably feel that with AI. The question is AI going to have as much of an impact as the internet did in terms of productivity? Because that's really the factor, is productivity, lowering expenses, maybe bringing jobs back to the US at lower rates, creating more efficiency. We're able to produce things cheaper, which ultimately makes more profit. And there's lots of questions and issues that are going to go along with that, whether or not it's actually going to take jobs or whether it's going to just transition jobs into different jobs. That's typically what happens when new technology comes in, is the jobs go away and people are displaced, but they typically can find new jobs. They just have to be retrained in the new technology. That's kind of the big deal right now, is everybody's talking about that, of their jobs are going to be taken away. We'll see what that looks like. So anyway, so my point is that interest rates could stay high, and they could stay high like this, around this 5.5, both at the long end and the short end of the yield curve for a long time. And we could see upside in stocks because of a mind shift change or productivity change. There's some things that could happen that are positive. On the bearish side, maybe interest rates the Fed can't crush inflation, and so they have to raise interest rates even higher than they are. That could potentially be a problem. So if we see inflation stabilizing and the Fed kind of stabilizing, and they kind of have in the last 3 or 4 months, that may not be a bad thing for the markets. And one other quick thing, and then we'll go through and look at some other ideas talking about interest rates, because that's really the biggest factor right now. Short-term interest rates are starting to stabilize right here. Here's how interest rates have looked. You can kind of see this uptrend. remember what's happening with interest rates. This is the 1 to 3 year treasury, and it couldn't go any higher than this because interest rates were at zero. Okay, this couldn't keep climbing because there was nowhere left for interest rates to go. So this is starting to flatten. It stayed that way for a long time. Eventually, when interest rates started to rise, then we get this massive bond collapse. And that's where we're at right now. We're flattening. Look how long we've been. This is, think of rates as the opposite direction up here. We're now short-term rates are stabilizing, and then we get just there's a little hiccup here of possible new upside. And that's on the really short end of the yield curve, which means that, let me change this perspective. Look at this chart, and then look at this chart. Okay, long-term bonds have been continuing to drop. Short-term bonds have not. They've been stabilizing and slightly increasing. What does that do to this chart? That actually takes this chart and it starts to lower this down. If those short-term bonds are going up, the short-term interest rates are going down. That's what we want to see. We want to see this starting to move down, and we want to see the TLT stay where it's at, or obviously move higher as well. So some interesting things. We're kind of at an interesting point right here. I think we could see some real action in both directions, both in the bond market, which I think will also spill over into the equities market. We're oversold. We've got a great setup on equities to be finding some support. And the bond market, I think if it starts to trend and move, you could get a big short covering rally right here. If you get a big pop and then you start to get short covering, this could have a pretty aggressive rally. We'll see if that ends up happening. All right, portfolios. Let's talk about that. So one of the ideas that I'm going to go back to then is when you're building out your portfolio, you can simply say, I don't want to do anything while the yield, or while the buy-sell ratio is negative, like this. Okay, I only want to be trading bearish strategies, trading put options, or in cash, and not adding into new positions. That's one methodology, and probably the safest and the most probably going to be the most profitable, because we're trading, we're buying, we're doing the same thing. We're adding into new buys when we have a buy-sell ratio that's positive. I'm doing a couple of different things right now, multiple portfolios. Part of it is for tracking, part of it is for testing, part of it is for actual money management. Most of the time, it's adding into positions in an uptrend. We're in a bull market, and you've got buy-sell ratio of 1, buying into muscle stocks that either are current buys, or you're adding into high-ranking stock new buys each day during that uptrend. While the buy-sell ratio is above 1, you're adding into only these high-ranking new buy stocks. Okay, that's a very simple strategy to do. One of the other strategies is obviously just to buy into a new buy stock every day. That adds more risk, it adds more volatility, but it also kind of autopilots everything, so you're not having to overthink too hard. Although there's not a whole lot of thinking that has to happen here. That's part of the value of it, is we're just looking for things that are in uptrend. So let's look at this currently. These two portfolios. This is the new buy daily. New buy daily is currently it has what do we have? I need to change this so that it shows me the number of holdings, but what do we got? About 20 holdings in here, and we're starting to see, some of them have been stopped out. We've got 2 or 3 that have continued to work, but remember, all of this has been during a downtrend, and we're down a couple of percent since this actually was September 1st. That wasn't January 1st, September 1st. Sell to buy. So, and again, that strategy is, had we been doing the buy-sell ratio strategy, we're not buying anything during the last 3 months. and we're just adding into, we're getting ready and starting to add into things. The other strategy is the sell to buy. The sell to buy is going out and looking for this tab right here, and that is a stock that has, this is kind of an ugly one, but it is the first buy signal after a sell signal. So something like this. Here's your sell signal, here's your hold signal, here's your first buy signal. It's buying into those strategies versus the new buy signal is buying into stocks after they go from a hold to a buy. So LPG, for example, this one has gone from a hold to a buy, and it's pulling it back in the list versus the new buy signal after the most recent sell signal would have been here. A couple of different approaches, and again, these are just a couple of different methods that I'm starting to track, and so that we've got a little bit of a reference point there on some of those. The other thing too is in the bear market strategy is this tab. I wanted to bring this up. Is you can also look when that buy sell ratio is negative. This weaklings tab is a good one to look for stocks that are going to be bearish. Number one, the rank tops out at 50. So it's stocks that are 50 or less, and they're stocks that have gone from a hold to a sell. So even if we were to look back here, okay, this would have been a great location, and it would have showed up in this scan right here. Okay, so you get buy sell ratio that's now less than 1, meaning the market is turning over or it has a bearish bias, and now you're looking for weak stocks that are starting to become weak and getting weaker. This wouldn't have been a rank 50, it would have been higher than that at this point in time, but same idea. Stocks in a downtrend, weak market, weak stock. Now it's, are we going to continue? We're going to start to reverse. Like I said, buy sell ratio now is extreme. I think some of these are going to start to rally again, up 2% here. So the strategy is we would shift away back from this strategy. We haven't really discussed that during this last downturn, but we will in the next one. We'll utilize some of these a little bit more in this next downturn, which hopefully is not anytime soon. Hopefully we get a bounce right here off of these lows. This buy sell ratio looks positive. We can go back to a muscle mini group, lower price stocks, high ranking stocks in a positive market. This is actually a nice looking one. This was a new buy list today. I already owned this one, LPG, and this one I didn't like the pattern, this flat pattern. I didn't want to go out and look to see if it was a buyout. So I just went with the next one, which was this one in the list. So from hold to buy at the market open today, it's up 4.8%, and it is in the new buy portfolio right here. Okay, so up 4% on that today. So that's, again, a pretty simple method of adding a new stock. It ends up being, a certain amount of work and it ends up potentially feeling like a lot of clutter, but it's a methodology, and you don't necessarily have to buy it every day. Again, you can do it based on when the market conditions have a heavy buy sell ratio of above 1, or you can do it. But in this case, this is just one of the ideas to be able to focus on. The other thing we've talked about is creating your own screen that maybe has a little bit tighter parameters, and so you're not getting a new signal every day. You've got, for example, this one has got nothing in it. The parameters are pretty high. Annual EPS, last quarter EPS, sales all have to be 20% or higher, and it has to be in a long-term uptrend, and it has to have changed from hold to buy. There's nothing meeting that criteria right now, so there's nothing that I would be buying right here. So that can be another way to reduce the number of stocks to only just the real cream of the crop, right? You know that a company like this is going to have great earnings. Yeah, I could even add something in to be like, okay, I want market cap. I only want larger companies. I want some decent volume on that. So you can filter it down. You can filter your way out of just about every trade too, if you want to, but there are ways to be able to just really tighten up the parameters so that you really are getting exactly what you want in what you feel like is an opportunity, is in what you feel like is lower risk, which I would agree with that. I would agree that buying into companies whose earnings are working, they're doing well, they're moving in the right direction, those are lower risk companies because there's a reason why the stock is going higher. It doesn't always have to happen, as we know that in downturns, even really good companies get thrown out. And as things start to reverse back up again, there's opportunity there. So building out your scan, that can be something that is that you're wanting. Excuse me. Here's another example of a scan. Instead of 20s, we're going with 5s right here. I'm gonna grab a drink. And one stock popped in there today, Lululemon. Okay, so I'm hold to buy. Had a big gap on earnings, and looks like it wants to continue moving higher from there. That may be one to consider. Again, just an example of how to be able to do that. In a lot of cases, though, you miss out on opportunities because ideally we want what is moving. We don't necessarily care why it's moving, because a lot of times these stocks are moving in anticipation of something in the future, not what's happening now. And so waiting for the earnings and waiting for everything to look good, sometimes you've missed the boat on some of those stocks. So it doesn't always have to have that, but if there's certain criteria, you're like, it has to pay a dividend, and why not? I want stocks that pay dividends. Then go for it. Add those in and rotate those stocks in. It's the rotation process. It's the portfolio building process that takes the guesswork out of it, because you don't have to say, well, I don't know, Jesse, it's got a negative 16 growth and last quarter's EPS was down. I don't know. I don't think I'm going to take it, right? That we start to ask ourselves all these questions, and that's fine if that's the strategy you're in. If you're saying everything has to be green here, no matter what, or I'm not taking it. Boom, you've just created a trading plan for yourself, right? Or you could say all it has to do is be a new buy, top of the list. I'm buying it. I don't care. Every day I'm buying the new one. That's a trading plan. As long as there's a system for how you're managing your risk, why the size of the position you're getting in. Now, for this portfolio strategy, I'm doing 2.5% entries. So of this pie, you can see that still got a lot of cash. And what's interesting about a downturn like we've had is it's a natural portfolio balancing process. I would imagine that when we start to move higher, this number is going to get larger and larger because we're going to have less and less stocks that are stopped out. The history here, for example, there were quite a few trades that have stopped out, but I've had some winners in there as well. So that's relatively flat performance. But the market has kept us out of the losers, and it's kept us from getting into more and more losers. Right now, what I would anticipate is as the market starts to shift, the new buys that are being added in are going to continue to work instead of not work. And so this number should climb, this number should climb, and the number of holdings should also climb. It may be that we get some of our winners like coal and oil that have worked pretty well start to waffle a little bit, and maybe those end up selling off and we take some profits on some of those, and the new stocks end up rotating in. We got into this one right here, I believe. And so it's had a decent move from here to here. Will it continue to go higher? We'll stay in it as long as it does, but it may not. Something else may start to take its place. And so it's this living, flowing portfolio that's always moving and rotating. And there's a system behind the process of buying and selling into the portfolio. And you don't have to say which one is the best stock to buy in here. There might be one that ends up performing better. That's just the price we pay, right? We can't buy. We're never going to know the exact one, but we're going to get enough in there that are going to work to be able to have some winners and ultimately increase portfolio size. That's ultimately the name of the game, is keeping losers small during market downturns, being in the right stocks during market upturns, making sure we're managing our risks so that when we do get stopped out, it's not a big deal, right? To be able to lose. So, we have one trade and we lose 18% on it, that's a hiccup. That's not even a big deal. It's a loss of 400. You notice most of these losses are around 2 to 400, some of the smaller ones. And that's the risk profile that I want to set up for this portfolio. Is I'm buying into these 2.5% with a stop loss, so that the stop ends up, if the stop hits first, it's usually about 0.25 or a third of 1%. So I'm putting 2.5% in, but I'm only risking a quarter of 1% of the entire portfolio on any given trade. Okay. A lot to digest there. It's relatively straightforward, but it really is a pretty easy methodology to be able to focus on. And then adding into that a couple of different ideas. Even right here, you can take a little bit more risk on a day like today, or an area like now, to say, I want S&P 500. Maybe I want to start considering some call options on S&P 500, because I know that buy sell ratio is deeply oversold, and we could get a pop right here. And maybe I want to have a little bit more speculation, a little bit more bang for my buck by buying an option right here, and seeing if it'll move 100 or 200% if S&P goes up 3, 4, 5%, something like that. And that's ways to be able to continue to evolve and change and build ideas around your portfolio, so that you're not just guessing, and you're not just swinging for the fences saying, oh, I got 10 grand. What the hell? Let's let it ride. Let's go 10,000 in SPY calls and see what happens, right? That's just a fast way to create a whole lot of pain in your finances. So you can continually trade in stock, and the vast majority of these methodologies is for stock trading and portfolio building. We're not looking for intraday trades. We're not looking for really short-term trades either. We're looking for whatever the market is going to give us in that kind of a time frame. We can't force it. We can't force what the market's going to give us. And so sometimes that creates drawdown, and that creates some losses, and that creates some stress. But we just have to be able to deal with that in a way. And the only way to do that is through position size and money management, and how we're going about this strategy, how we're going about this portfolio. I might be a day trader, and I might say I've got $100,000 and I'm buying Apple, and I'm putting all $100,000 in Apple, but I've got a really, 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 really tight stop loss, so that if it drops by 400 points, I'm automatically selling, or $400, I'm automatically selling. You can still buy one thing at a time and manage your risk effectively. I just don't want to do that. It's too intense. It's a different strategy, and it's a different methodology. And so is this. This is just a little bit different approach in portfolio building and management and stock selection, that keeps things routine and keeps things systematic, so that you don't have to be the genius, right? You let trends happen. You let the software see what's coming, the cream of the crop, which ones are working, what are the market conditions, should I be buying into those kind of stocks, and then managing risk, so that if things are flat or sideways, you're not out of the game. Staying in the game is the name of the game. And a lot of traders and investors just risk way too much, because the market will create the most pain for the most people for the longest period of time, and it ends up being us retail traders. For the vast majority of us, is the market likes to inflict pain, and that's because large institutions are ultimately running the market, and but they also have to, they are competing against each other, and they are in a marketplace as well. So I think there is manipulation, but I really don't believe that anybody can do it for very long. It can probably be done in real short-term scenarios, but overall, the market is so huge that we can just cut our little piece out of it, and try and grow our assets a little bit more than in other ways. There's risk in everything. There's risk in savings accounts because of inflation. There's risk in equities because of volatility. There's risk in, you know, in putting it under the mattress because of grandkids or fire, or you know, whatever the case might be. There's risk in anything we do. We just have to know how to manage it and know what the possibilities are, and then we're good to go. We've got a strategy. I'm going to end on that note. I appreciate everyone's time and effort, and we will see you all on Thursday. Thanks a lot. Bye now.